And welcome to another episode of Preparing for the Unexpected. I'm your host, Alex Fullick, and today we're going to be talking about a key area in disaster recovery and business continuity planning and building our programs. Actually, it's an area that's big in many different organizations, and depending on what you do, this will always come up at some point. You know, at our banks, at our manufacturing industries, everywhere, this comes into play. And we're going to be talking with a previous guest who's a colleague of mine, but more importantly, a friend of mine. We bounce a lot of ideas about disaster recovery and business continuity back and forth. We're actually working at the same place right now, but not actually working together, unfortunately. Maybe one day soon. So I'd like to welcome back to the show my friend Alvaro Orrantia. Welcome, Alvaro.
Hi, Alex. Thanks for having me back. Great to be on the show with you.
Well, the first episode went very well about perspectives on business continuity management, so I thought I'd have you back again. And as I started to say at the beginning of the show, we're going to talk about something really big and important to just about every industry, every organization, and that is risk management. I can probably hear all the groans out there now. I know it's not the most exciting topic, but it's actually a very important one. And I know, Alvaro, you're quite well versed on risk management. But before we get into that subject, can you kind of refresh our memory on your background and the things that you've done in the past and how and where you've got to now?
No, thank you, Alex. So I am in the IT world by academic background. I'm an IT engineer. A few years ago, I wanted just to see more the business side of things, and I went for an MBA. And little by little, I started getting more and more into different aspects of risk management, and specifically around business continuity, disaster recovery, a bit of emergency management, and also information security and privacy. So that's where I'm coming from.
And you recently, correct me if I hope I'm remembering this right, recently received your risk management certification, correct?
Yes, thank you. Yes, I received one of the different types of designations for risk management. In this case, it is around IT risk and controls. Yes.
Well, then you're going to be a great person for us to learn about risk management from today. So to start off with, let's ask a very basic question. What is risk management? Can you define that for us?
Well, this reminds me of a story I had with one of my former leaders when I was in consulting. He told me that he frequently had a hard time explaining to his daughter what risk management was, what he did, because he was the risk management lead. And I think I'm alluding to it because it's very wide and it's very ethereal in many ways. We undertake risks every day without us even knowing. So if we just decide to take a secondary road and not the highway, we undertake a risk. But I guess risks in many ways are mostly defined as events that may or may not happen. So they have a likelihood of occurrence, and those are events. That could be threats, I guess. And as a result, if they materialize, they have an outcome or a consequence, right? And it is risk management is the practice of understanding what those events are, what the likelihood of occurrence is, what the consequences are, of course, and also to adopt a certain posture in front of those events, right? So that is in very general terms what I would perceive as risk management. And as I said before, the risks happen all the time, and we take them and we manage risks all the time without us even knowing.
So what kind of things would occur on a regular basis that myself, the layman, just kind of waking up in the morning? What kind of risks am I facing every day, or that everyone is facing every day? What kind of risks are we talking about?
Well, they're very specific to each one on a personal basis. I mean, to start with, if you wake up in the morning and you live in a two-story home, the risk of you fall up the stairs is one of them, right? Or that you fall off your bed also is another one, or even that you slip and fall in your shower. So there's many, many risks that we see on our day-to-day activities. And again, using that as an example, we might be saying, well, if I have the risk of falling in my shower, I better just put something on the floor that prevents me from slipping, right? And that's part of what I would like to do, what I would be doing to manage such risk and to try to prevent it, right? So it is, on a day-to-day lives, we have many, many risks from the moment we get up. And when we go out to work, we come back from work, we're going through risks. It's just that in our day-to-day activities, we've learned to understand those risks, even just subconsciously, and to manage them, right? But when it's taken to a business perspective, that then we're having a more structured approach, and there's documentation, there's a lot more analysis that is taken, because it's business or business decisions what need to be made as a result of that.
So when it comes to business and business continuity, what kind of risk types are there that we would be looking at for business continuity programs and disaster recovery programs? What kind of risk are we talking about there?
Well, in terms of business risk, there's as I said, is a very wide variety of risks. So at a business level, we have financial risk, we have reputational risk, regulatory risk, market risk. Even strategy risk. So what if the business strategy fails? That's strategy risk in many ways. And within, there's a very large category that is called operational risk. And business continuity falls into that category. So which is really the risk of business interruption due to a certain event or even an unforeseen event. So that's where business continuity falls in. And within business continuity risk, which is the continuance of the business, what is at risk, then we have also disaster recovery, which is an even more specific kind of risk, which is IT continuity risk.
So how do we determine our, I think you used the word exposure or vulnerability to these risks. How do we determine that? Getting up in the morning, you said, is one way. Getting up and stepping in the shower, you've got a mat there, so you've gotten rid of the risk of a slippery floor. But what do you do in organizations to help get their business continuity programs going, or where does it fall in the business continuity program? When should they determine what risks they have?
So at the end of the day, any business continuity program or disaster recovery program should be hinged on what's at risk and what is the risk appetite for an organization. In terms of business continuity, we're looking, or even any risk, I would say, we're looking at the regular risk management life cycle. So the first step, I would say, is we need to identify those risks, right? And that begins even with a more basic part, which is the identification of threats. So what can happen? So, for example, if a business is in a certain location that is more prone to, let's say, weather-related events such as tornadoes. So we go through that process of saying, okay, tornadoes are one type of threat, and we might have earthquakes, and we might have severe rain or snowstorms, for that matter. And following that, we look at the likelihood of those events happening, right? So yeah, maybe 1 in 50 years we have a snowstorm, but every year we have tornadoes, right? Especially, for example, in the Caribbean, when there's more propensity to hurricanes. Mm-hmm. And also based on that, then we follow another more detailed analysis in terms of how vulnerable are we. So we might have hurricanes, let's say, in the Caribbean every year between the June and the October time frame, right? But one thing is that if our facility is just a regular house that can be affected by a hurricane, versus our facility being a bunker. So if we are in a regular house, we are more vulnerable to that event if it materialized to affect us. If we're in a bunker, if it materializes, it wouldn't affect us, so we're less vulnerable. So that's another part of the first stage, which is the risk identification, which is the threat analysis, the likelihood analysis, and the vulnerability analysis.
So how would you recommend that organizations go about doing this? Just sending out questions to people, or just, send me your thoughts and that's it, or workshops, or, what's the process of identifying these?
So So the regular process also is run asking the experts. So you probably have a mixed team of experts in that is specific to each organization and that is specific to each industry. So you want to have an understanding of your vulnerabilities from the folks that are within the organization, but also want to have other folks who are expert on these types of events we're looking at, to have their own thoughts and their own views and also weigh in, because we might be missing a few things. So it's a mixed team of experts. Typically, we do it through some questions, and then we validate some of the questions and answers through workshops. And once the overall landscape of risks, vulnerabilities, threats, the likelihood of occurrence is put together, we also look at the consequences. So if this happens, this is the likelihood. What is the consequence? So if we have a hurricane and our facility is impacted, we will be out of business for this many days or this many months until we build a new facility. Right? So based on that, we identify the impacts really associated with the risk, which at that point, now we would complete a full risk assessment. So that is the first key stage that is going to get us prepared for the second stage, having more to do with the management of the risk. And I'm combining, in technical terms, when I'm saying first stage, really first and second. So in the more conservative approach to risk management, you have the risk identification, and then you have the risk assessment, and then the management of risk in itself. And at that point, we're looking at adopting certain postures to address that risk. The one thing that we cannot do with risk is to ignore it. But then we have many other things that we can do or combine it, right? So we
Sorry, did you say, the worst thing we can do is ignore a risk?
Yes, exactly, yes. So by ignoring risk, simply it's not going to go away, right? It's like adopting sometimes what they say, the ostrich approach. So when I'm hiding my head in the sand, but still hurricanes are happening, right?
Mm-hmm. Right. Okay. So now that you've got your risks, identified, the consequences and the likelihood, what is the next step? What do we do with it now?
So at that point,
do we present the findings to anybody?
Well, we present findings, absolutely, findings to the executives and the business decision makers at that point. But we also put together some recommendations, and that is also part of what we want to do by adding value. We could say these are the findings, these are the risks, this is the likelihood, but typically the question that will be asked is, so what? So I think we need to be prepared as risk practitioners to answer this, so what? And that to me maps to a few things. Not ignoring, of course, but one is we avoid the risk. So if we have a critical facility in the Caribbean, avoiding the risk would be to not have it, right? We can transfer the risk, which typically is using insurance. So we just purchase insurance and we transfer the risk to an insurance company, right? We can accept the risk. We're saying, fine, we will do nothing with it. We accept it. That's the cost of doing business. We will not have a bunker. We'll just live in a regular house in the Caribbean. And fourth, really, in this case, we would mitigate the risk, really, which is really saying, okay, let's move to a bunker, right? And that way we mitigate. At the end of this process, we will always have what is called a residual risk, right? And by the way, all of these different strategies to manage risk can be used in combination, right? But at the end, we'll have what is called a residual risk.
Can you give us an example?
So to give you an example in simple terms, so is if I have this house in the Caribbean, right, and the house is worth $1 million, so I will purchase insurance for $600,000. My residual risk is $400,000.
Okay.
Right, and the other concept really is the inherent risk. So the inherent risk is if I do nothing, what is at risk? In this case, $1 million. Put it that way.
Okay.
Yep.
So you present the findings to the executives for approval. What do we do with them then? I'm assuming this is how it goes. We've identified these risks. This is the likelihood. Here's how vulnerable we are or aren't to them, and they're put in a specific order of priority or impact and probability. What do we get executives to agree to that? And once they do or don't, what's the next step? We've got all these risks identified. What do we do next?
Yeah. So once the executives agree on the risks that we have identified, and of course in the assessment overall, then we work towards identifying the different strategies to manage those risks, right? And into those strategies, we select, we have a cost-benefit analysis, of course. So in this case, let's say that building a bunker is $100 million, and what's at risk when the regular house is $1 million. So maybe it's not worth going the bunker side, right? So we do a bit of a cost-benefit analysis to understand really if the cost of managing that risk and reduce it, I guess, to the point that we have that residual risk is really worth what we're trying to protect and the consequences we're trying to avoid, right, or to minimize. So based on that, we present the executives also with that list of strategies and recommended strategies to manage that risk, right, to reduce the risk. And there's at that point a decision-making process, which really kind of completes part of the most important part of the risk management cycle, the decision-making process. And once those decisions are made, then we're looking at implementing those decisions. So one thing is to say, yeah, let's build a bunker. Another thing is to actually build, right? So that's the next stage.
And welcome back to Preparing for the Unexpected. We're talking about risk management with Alvaro Orrantia. And just before we went away on the break, Alvaro, you mentioned that we've got all these risks now. We've identified and we've done a cost-benefit analysis, which, curiosity, do you do cost-benefit analysis for every risk identified?
No, excellent question. So we do cost-benefit analysis for when it's possible. So there's items that are really hard to quantify, like reputation, for example, and goodwill. Many companies go through extensive lengths to do it, and they can technically do it, but it takes quite a lot of time and it's quite costly as well. So many times what organizations do is saying, hey, there's a cost here, and sometimes it's just invaluable or very hard to quantify. Yeah.
Can sometimes that hard to quantify cost be, really significant, and organizations still might want to do something about it because reputations can sink companies, right? If you want to accept a risk like that, you could sink if something happens. Absolutely,
yes, and so in those cases, I mean, what's really the big difference is that instead of just putting a number, organizations, they say this is very high or high, so they quantify it that way, but they don't necessarily a cost to reputation or to goodwill. But there's still, based on their own feeling of the executives and the experts in the industry, they still have a way to dictate that or to manage that, and then to make decisions associated with that kind of quantification.
Okay. So we've got all these risks now, and we've quantified them, and for those that we do a cost-benefit analysis for, we've got them prioritized. What's the next step? I'm sure that these risks don't just sit in hopefully not in a pile of paper somewhere. What's the next step when it comes to business continuity and disaster recovery plans? What should happen after we've identified our risks?
So as I mentioned before, so business continuity and disaster recovery are a subset of operational risk. So in this case, we just look at the risks, and very likely we have a risk associated with business interruption and facility interruption as well. So that would result in activities such as, in this case, identification of alternate facilities, and strategies also such as cross-training of personnel and also just documentation. Those are typical strategies that are adopted as part of the business continuity process. But I would start a little bit earlier in that case. I would just look at the very beginnings of business continuity. So once we're saying yes, we have a risk of business continuity, and this is the risk. We go through a more detailed assessment, which is the business impact analysis. So at that point, we're saying the associated risk, sorry, I'm still fighting a cold, associated risk of business interruption results in the following impacts, right? And understanding also what are the different dependencies at a process level with other processes within the organization and on the technology side, which links to business continuity and then disaster recovery. But that's the beginning. And the development of business continuity plans also is linked to the risks that we have identified, and the strategies within the business continuity plans addresses some of those risks. So if we are in an area that is prone to pandemics, for example, personnel risk or cross-training of personnel from the other side of the coin, really, which is the strategy, is something that is more prevalent in the development of business continuity plans. But if we are at risk of a facility disruption, say we're in an area that is more prone to earthquakes, then probably there's something that, from a business continuity perspective, needs to be emphasized a little bit more, and we need to be a little bit more strict, put it this way, in the identification of alternate facilities to continue business process.
You, excuse me, now I'm getting your cold. You mentioned dependencies when you're building some of your plans and things. Can dependencies be risks?
Absolutely. So if I, as an organization, have a dependency on another process within another department, put it this way, or even a third party, if that dependency, that requirement really has been impacted, that could trigger a risk. So what is the likelihood of that dependency also being unavailable or not being there for me? So we'll have also, in this case, a risk associated with that dependency, yeah.
Would that be like your supply chain, risk management type of plan and process?
Yes, exactly. So at that point, we're looking into third-party risk, and there's different ways to mitigate it, different strategies, depending on what the risks are. So for example, if I have a dependency on a third party, and that third party has built pretty much a niche core competency, so at that point, I would be in a greater risk. And if I'm just depending on a third party that has multiple competitors, right? So and I can switch very easily from one to another. And I adopt different strategies depending on that kind of relationship I have and the third party capabilities and the industry in which that third party operates.
So would I be correct in saying that not only would I be doing a risk assessment against my third parties, should I also be doing it on myself, on what I provide other parties?
Yes, and I think, yep, but I think that that's the overall risk assessment. When you conduct your risk assessment, part of your risks include also not only your ability or inability to provide your services to your clients also, but by the same token, there's client risk, which is, do I have a concentration risk on just very few clients? So if those clients go away, am I going to be in trouble? So it is a two-way street, essentially. What can affect or what can prevent me from reaching out to my clients and give them what they need, but also what happens if one of my clients goes out of business and it affects me to the point of no return. Yep.
And I assume it would be, and what happens to my clients if I go out of business, or not so much out of business. Let's not say that, but experience something. They're dependent on me, right? So I would have to have something in my either communications plan or business continuity plan to identify, to let them know, there's going to be a problem. You're not going to get the product you're expecting or the service you're expecting or your checks when you think you're going to. I'd have to incorporate that into my plans, would I not?
Yes, exactly. And then at that point, we're looking into more of a crisis communications plan and even being able to proactively reach out to the clients when and if an organization is going through trouble also helps in reputational risk management. So an organization may be going through some issues and may be prevented for some time to provide those services to the clients. But if it's managed proactively, at that point, it will become even a favorable factor in the middle of all the unfavorable things that may be happening, a favorable factor for the organization's reputation. So when an organization goes back in business, clients will regard that organization more highly, and the organization is going to be more likely to recover from that interruption.
And I remember from us working together at a organization years back, we had some of that in place, where we tested some of that, sent off tapes off site. If we have a problem, here's how we're going to get you your information, right? So, excuse me, I am getting your cold, Alvaro. We need to make sure that, like you said, a two-way street. We got to make sure we have that on our side as well.
Yes, absolutely. And I remember at those times, we reached out proactively to our clients, and we told them, hey, we have not received the following files from you. What do you want us to do, right? And I think our clients appreciated that very much. We even had a third-party issue because we depended on a courier to deliver some of the information that we had in ways of checks and receipts and documentation, and that wasn't happening. So we reached out to the organizations and told them, we're open. We have a physically open window here for you to come and pick up that information because our couriers are not operating. So that also helped quite a lot in helping our clients understand that no matter what, we're doing our best to manage the situation, right? And that helped us in many, many ways, and also it positioned us as a more trusted service provider for our clients in the future, yes.
I think I recall the incident you're talking about, and I'm not sure if you were still there, but I'll share this with our listeners. We did the same kind of a test where we sent a tape off saying, we're unable to provide you the information that you require, but we will send it via courier down to X location. So we did. We sent it down. The courier was stuck in traffic because there was an accident on Highway 401. And then when he finally arrived, he put it on the desk of the person that was supposed to receive it, but that person had already gone home. And there was nobody there to accept all this information. So suddenly they had identified a risk at their end, saying that we only have one person who can do this. So it was rather interesting to go through that because they identified things they were completely unaware of. They just assumed it would happen between 9 to 5.
Yeah, exactly. Yes, and digging a little bit deeper into the business continuity cycle, I'm probably going to be a little bit off topic. That is what you do during simulations, right? That is really the most significant value added when you identify those gaps and you put them on the table and you address them, right? You address them proactively. Yes.
Well, then you also, I'm assuming you, after some of these exercises, you reevaluate some of your risks, right? Because maybe by testing, you've helped mitigate some of the risk probabilities and things that might occur.
Yes, and I would say in a more wide scenario, I mean, you constantly evaluate your threats. So because let's say climate change, for example, the hurricanes might be more often or stronger, right? And also, as you build certain capabilities, your vulnerabilities change. You are less vulnerable. So you build a bunker, so you are less vulnerable to hurricanes. Or you cross-train people, or you identify that second person that is going to be there to pick up the tape, then you're going to be less vulnerable. So it's constantly going through the cycle and the next stage really is risk monitoring and risk reporting. So by monitoring, we're saying, okay, are we going through the same risks? Are we going through the same vulnerabilities? And have threats changed in any way, right? I'm sure that many of the threats that we have in Canada today are quite different from what we had 10 years, 20, 50 years ago, right? And by the same token, our vulnerabilities have changed. So that is part of the cycle. The other part is risk monitoring and risk reporting to the executives.
So how do you report to executives, the risk monitoring? And because up front, we talked about, we have this initial risk assessment or findings report. So how do you keep that going, updating it? Like, what do you recommend? You don't just, I'm assuming you don't just hold a test and then just say, okay, we'll check these couple of risks. How do you keep that whole process alive and, making it part of the culture?
So there's an official, or there should be an official risk record, also named the risk registry, where we keep track of all those risks, right, and all the different, again, likelihoods and vulnerabilities and assessments, right? And that's the primary source for the official book of record to use to report back to the executive. So this is the risk landscape that we have. This is where we stand on those risks. And also, that links to what are we doing to mitigate those risks, to manage them in a certain way, including also tracking acceptance, right, or tracking full remediation, and also what is the residual risk. So on a regular basis, we're using that to report back to the executives to get executive visibility, to also confirm or seek additional decisions, and also to get support from the executives to address those risks. And that completes the entire risk management cycle.
So who do you recommend owns this risk registry? Obviously, the business continuity group picks it up to some degree, but do they own the risk registry, or should somebody within an organization or an area within an organization own that?
Yeah, so that comes to what is being more and more prevalent, the concept of the three lines of defense. So the first line really is the business, and the business owns the risk. The business owns the processes and controls to manage that risk or to mitigate that risk. So also there's another concept that is quite important to talk about, which is control. So the process is what I follow on a regular basis, but controls are in certain aspects also those controls that help me manage that risk. And there's compensating controls, which is if I fail in this control, what other control will kick in to minimize the risk from materializing. So the business owns that, owns the risk, the processes, and the controls, and also owns the key risk indicators, which typically measure what kind of risk levels I have, and past what point I'm getting to the point of no tolerance, right? So I'm saying, for example, if I have many facilities in the Caribbean, so if I increase the number of facilities past a certain point, that is probably too risky. Or if I have too many people in one location, that is probably too risky. And that could be defined, let's say, for example, in a way of the percentage of my overall staff that is in a hurricane zone. So when I go past, let's say, 90%, that is way too much. But that tolerance is defined by the business, as the risk also is owned by the business.
So does that mean they own technology risk too?
Yes, so the business owns technology risk, absolutely, including the many other aspects of technology risk. I'm not talking only about technology interruption, but also information security, absolutely.
Okay. How often, should this risk registry be looked at? What kind of things should trigger, the risk registry to be looked at? Not just a test, but
So it is good practice to look at it regularly. So I think organizations need to develop more and more a risk culture where they are constantly, staff is constantly risk aware. So I guess in the best practice at least once a year, right? But if organizations are risk aware, they're constantly on the hunt, I guess, for elements that help them understand risks better and update the risk register. So if one day you see a piece of news happening that might affect you, so you update it. So if, for example, I'm not concerned about pandemic risk, right? And at some point in time, one day I see an outbreak nearby of a certain, let's say, virus or flu virus, then probably I need to adopt measures right away. I cannot wait 1 year to update it. So organizations need to be constantly on the hunt for elements that affect their risk landscape and also trigger right away immediate responses, right?
Okay. And welcome back to the show. We're talking with Alvaro Orrantia about risk management. And Alvaro, you mentioned some different risk types that are out there, and operational risk, business continuity, and disaster planning tends to fall under. But can you tell us some of the other about some of the other risk types, like regulatory, and how regulatory risk can impact an organization or business continuity or anything like that? And maybe a couple of other ones to give our listeners an idea of things that they should be looking for.
Yep, absolutely. So I think one more prevalent risk as well is regulatory risk, in the sense that there's a regulator, or there's multiple regulators nowadays that influence the way organizations conduct business. And sometimes they are more like the formal regulators. Sometimes it's just communities, right? So there will be this community pressure around being environmentally friendly, for example. But there's also other areas that are heavily regulated, like healthcare or like financial, for example, that are heavily regulated. So the regulatory risk also speaks about the risk associated with being in a state of regulatory non-compliance. So that would result other effects with, for example, impacts on reputation. So what if the regulator publishes that XYZ or your organization actually is getting fined or is getting investigated because of certain things, right? So that affects your reputation. And another case also is, of course, the associated financial penalties and even legal risks associated with that, based on the regulator imposing penalties for imposing all certain processes or ways to operate on an organization that has been in a state of non-compliance.
Is that like Sarbanes-Oxley, and things like that, that come into play that organizations need to, pay attention to? Because I know having sat through some of the sessions with regards to that, there's penalties if we don't have this in place, if we don't address that, and is that like one of the examples you're talking of?
Definitely. So Sarbanes-Oxley requires certain controls in place for financial reporting and to avoid fraud and other related issues. So it is not, for example, triggering controls necessarily around business continuity or disaster recovery, other than preservation of financial records. But if an organization fails to have controls that prevent fraud, financial fraud within that organization itself, and hence to fail to protect the investors, then at that point, organization is exposed to Sarbanes-Oxley related penalties, right, and requirements. And from that perspective, organizations have needed to adopt certain controls and from a financial management perspective, right? So from my past life also, we had to work with our clients to establish those processes and to establish different and document different controls in processes related with financial controls. So there was a process analysis that linked those organizational processes with the financial reporting cycle, and that made those processes almost in the scope of Sarbanes-Oxley, and then helped us creating controls. So my point is really that risk management is not only around risk of facility destruction or business continuity or IT continuity. It is also around other types of areas within an organization that in this case would be triggered by regulatory requirements.
Well, you mentioned quite a lot of good information there, and it got me thinking, what about risk management and privacy or information security? What are your thoughts there, considering that's in the headlines quite a bit lately? What are your thoughts with organizations on how they should be managing that when it comes to their risk and exposures, etc.?
Well, back a few years ago when we worked together, PIPEDA, in this case for Canada, came into effect. And as an organization, we had to adopt different controls, right? At that point, we created a privacy policy, which we didn't have, so that's one of the controls. And we created also a series of awareness events and documentation associated with privacy. So all those things are associated with the privacy legislation that came into effect. Now, on top of that, as an organization that operates in multiple jurisdictions, namely different provinces or different countries, each one has its own different requirements, so an organization needs to adapt to those requirements. And now specifically for more recently CASL, which is the Canadian Anti-Spam legislation, that has forced many organizations to reevaluate their relationship with their clients. And from a CASO perspective, all of them have had to say, okay, we were including you in our distribution list, no more now, or we're giving you an opportunity to opt out. And from a privacy perspective, that has deep links into the overall information technology area associated with records management and records retention as well. So it is important that from a regulatory perspective, the entire organization understands what the regulation says and understands the impacts of that regulation so that it can properly adopt the different controls and processes to deal with it. So, for example, in privacy, it's not only a matter of naming a privacy officer. It isn't only a matter of just sending an email saying, hey, we respect your private information. It has to do also with a lot of changes in the technology side of things to adapt to that regulation.
So, based on what you've been saying, that it sounds like risk management isn't just one little area; it's everywhere.
Yes, exactly. It's everywhere. So, as we started talking in your show, the moment we get out of bed, or even perhaps before, we are managing risks without us even knowing, let alone also in the business, right? So if it is in our very basic life, in the way of doing business, it's got to be true. So risks are spanning across all different business areas within our organization, the different departments, and across all different sectors too. So again, if it is healthcare, you got certain risks. If it is financial, you got certain risks. If it is data processing, you got different risks. Manufacturing as well. They all have different risks. One of the companies I worked for before was very comprehensive in the sense that organization had its own insurance company, had its own manufacturing facilities and departments, had its own third-party management, had its own financial issues too. So it was exposed to a lot of those items, and you could see it more clearly. But in any way, organizations have, all of them, exposure to all those different risks, and as an organization as a whole, they would need to understand them in a comprehensive way, and most importantly, the linkages across the different departments and different risks. So a risk from an HR perspective may have also links to the financial department and financial processes, and to the IT processes as well. So all those links need to be understood, and their interrelationships also need to be understood.
So how do you recommend keeping that all those dependencies and links in line? What recommendations do you have for organizations to make sure that happens?
So I would say two key things. One is it is important that the organizations create a risk awareness culture. So by virtue of doing that, anybody should be able to say, hey, I got this risk or this item in my department that may pose a risk. And by association, it might also be linked to this other department or this other process. So by having a risk awareness culture, you are better positioned as an organization to understand each department's own risk and each risk's interrelationships. And also the other part is also creating a risk management team that helps put everything together, helps being the glue and facilitate all those discussions as well, and also be that conduit, that official conduit, to put in a book of record that risk landscape for the executives to understand and to make valuable decisions.
So creating a risk culture, is that, how do you do that without creating panic? And I know both you and I have been in meetings where people have, oh yeah, what if this and what if this, and they just go on these big long, speeches about all these bizarre things that can happen. So how do you create a proper risk culture within an organization?
It is definitely a process, a long process. You need to create it also through awareness, right, and support. I constantly just try to speak to my fellow practitioners that I think it's better to position risk as a way of a business enabler than as a way of creating panic. So many people have been talking about the many disruptive events and September 11 and all the different the hacks of the day, I guess, from the month or of the week. as a way to get people a bit scared and react. But very few people actually speak about the many benefits that were derived from a proactive approach, where actually impacts were avoided. And I think that's a better way of doing it. If organizations understand that there's a business value proposition by proper risk management, you're creating a more positive and I guess a more pervasive risk awareness culture overall. But as I said, it takes some time to do it. It takes constant reminding, constant dialogue at different levels. So we talked earlier about the lines of defense, and I was saying the business owns the risk, but there's also a risk management layer that helps creating that risk practice, creating the risk policies, and also being that conduit to the executives. And there's a third layer, which is what you want to have, but in a certain way you want to avoid, which is the audit layer. So you want audit just to be also a conduit to the executives and to the board, but also you want at the same time audit to be clean, to be saying, yes, we have nothing to worry about from this perspective.
Well, you said that magic word, audit, and I'm sure many listeners just all of a sudden went, ooh, as soon as they heard that. But you're right, audit's there to help, and keep us on track. I always make friends with audit. So we've come to the end of our show. Alvaro, I want to thank you once again for enlightening us on another subject, and this week it being risk management. There's lots here. I hope people take some thoughts away and take a look at their own programs and how they integrate risk management processes and procedures or enhance anything existing, that they may have. So thank you once again for joining us, Alvaro.
Thank you, Alex. Happy to be here again.
And I'm sure I'm going to have you back again.
Great. Happy to as well.
And to everyone that's listening, again, I just want to let everyone know if there's a subject that you want us to talk about, please send me an email, info@stone-road.com, or you can connect through me through LinkedIn. I'm on there, Alex Fullick as well. Send me an email, send me what you want to talk about, or maybe someone else should come on and talk about, and we'll see what we can do about getting you on the show and getting your issue or your topic addressed, and give you the information you need to make your disaster recovery and business continuity programs or any other aspect of your organization, make it stronger and better. So until next week, thank you everyone. Thanks again, Alvaro, and stay prepared, everybody. If you liked that video, thumbs up. If you didn't like that video, thumbs down. But leave a message and let me know what your thoughts are. If you'd like to be a guest on the show to talk about something related to business continuity, disaster management, COVID, personal well-being, anything that's relatable to those subjects, you can reach me through my LinkedIn profile, which is in the video description. And of course, don't forget to subscribe. In the meantime, stay prepared, everybody.